deluge of public issues in the last 1 year. And among the new listings of FY21, the performance of Computer Age Management Services, or CAMS as we know it, really stands out. Hi everyone, I'm Karunya Rao, and on Ideas for Profit today we will decode the fundamentals of this very stock. Now, CAMS shares have almost doubled from its issue price of 1230 rupees in less than 9 months, outperforming broad equity markets by a huge margin. In comparison to the spectacular stock performance, the earnings of the largest registrar and transfer agent of mutual funds in FY21 was relatively moderate. So what explains the surge in the stock price? We told you in March that this technology-led financial services company ticks all the boxes of Buffett's investment philosophy. The business's unique strengths along with sectoral tailwinds explain the high interest in the stock. In a duopolistic industry, CAMS enjoys a 70% market share in terms of mutual fund assets serviced at the end of March, and this share will rise to 73% once migration of Franklin Templeton's assets is completed. Now, CAMS business has several other positives. It's highly protected from competition because replacing RTA is not that easy. Annuity-like revenue, a debt-free balance sheet, high operating leverage, which implies it gains from technological advancements and higher volumes. Business with robust return ratios is something we know of. There's a potential upside from new initiatives that have not been factored in the valuations yet and actually could be long-term drivers of earnings as well as valuation. With around 90% of its revenue coming from mutual funds, CAMS will be a key beneficiary of the growth in the mutual fund industry. Mutual funds so far had been going from strength to strength. However, the economic crisis brought by COVID-19 pandemic impacted the mutual fund industry in FY21. Equity funds saw net outflow of 39,328 crores last fiscal, notwithstanding the inflows in the last month of the financial year. While the growth of MF industry, especially equity assets, was disrupted by the pandemic, the long-term structural growth story remains intact. Moreover, after a gap of 8 months, the industry saw a net equity inflow in March as well as April. This could be an inflection point, and healthy inflows in equity schemes could actually resume in FY22. Let's look at the earnings. CAMS' main revenue stream consists of fees charged to mutual funds as a proportion of AUM serviced. This makes revenue a function of two things: the assets serviced by it and the blended yield, which is the fee that it earns on these assets. In FY21, average assets serviced by CAMS were up 10% YOY to 20 trillion rupees, better than the industry average AUM growth of 8.6%. However, the growth was largely driven by debt and liquid assets, resulting in the drop in the proportion of high fee earning equity to 34% in FY21 from 37% a year ago. The unfavorable change in asset mix led to flat revenues despite overall AUM rising in FY21. While the top line was subdued, margin expanded to 38.7% in FY21. The margin improvement was primarily aided by contained operating costs. CAMS has other businesses as well, which include the likes of account aggregator, payments aggregator, servicing AIFs, PMS, loans against mutual funds, central record keeping agency for a national pension scheme, insurance repository, and even eKYC business. The fees earned from these non-mutual fund business lines declined 25% last fiscal. Though the future potential can be huge, all these businesses are at a nascent stage right now, and their contribution to the overall revenue is minuscule. Though there is no direct listed peer for CAMS, it can be compared with listed asset management companies like in HDFC AMC, Nippon India, UTI AMC. The question then arises, why invest in CAMS, which is a proxy play for mutual fund industry, when you can directly invest in the stocks of these listed AMCs? Well, investing in AMC stock exposes investors to company risks like an AMC assets may decline even when industry AUM is growing, while CAMS has low business risk and is relatively a stable play on the overall mutual fund industry. Perhaps for this reason, CAMS is trading at a premium valuation to the other AMCs. Now, many would argue that CAMS does not have much pricing power and earns lower yields on assets serviced. This is something akin to an auto ancillary player that operates on thin margins despite being a crucial supplier to OEMs. So then what justifies CAMS' premium valuation to AMCs who can squeeze its margins? Well, just like iPhone or Windows, which has become core to a user's life or work, CAMS products and platform are core to the operations of mutual fund. CAMS' position is very strong in the mutual fund industry as it is one of the only two service providers. The sheer volume handled by CAMS more than offsets the weakness on pricing front, justifying its premium valuation. After the recent rally, CAMS is trading at a rich valuation of 43x FY23 estimated earnings. Given the robust return ratio, ROE of above 30% and CAMS vantage positioning, the premium valuation according to us will sustain. So investors should look to buy this long-term compounder on a price dip amid a volatile market.